kick things off. So I'll kick things off with a quick overview of the pillar initiative by the OECD. Just give me a quick minute to. There we go. So I think everyone can see my screen. Perfect. So I'll just give you a quick update on the pillars, what it is, and where they're at in general implementation before I turn it over to the next speaker. So what is the OECD two-pillar tax reform? So we're looking at really two aspects. So pillar one is the reallocation of taxing rights, and pillar two is the global minimum tax. So far, this has been an approach that's approved by 138 of the members of the OECD G20 Inclusive Framework on BEPS. And the objective is addressing the tax challenges from the digitalization of the economy. It's a direct measure, action measure for Action 1, which resulted from BEPS. So what is Pillar 1? So generally speaking, Pillar 1 will apply to about 100 of the largest and most profitable multinational entities. So we're really looking here at gross revenue exceeding 20 billion euros and profitability above 10%. Those are the two key metrics that we're looking at when we're asking ourselves if a company is in scope for Pillar 1. The objective is to allocate profits to countries where they sell their products or provide their services. So ultimately ensures that the M&E will pay income tax based on the location of the users and customers. And this is what we call nexus. So the minute there's a transaction between the company and the customer, then it's determined that there's a relationship between the two of them. You'll recall that for the past 100 years, the tax system has been based on where the company was operating and taxed on that basis. So this is going to change that. Ultimately, it caps residual profits allocated to the market jurisdiction with safe harbor rules on sales and marketing. That's the amount B. And it requires all parties to remove all digital sales taxes and other relevant similar measures. And that's not necessarily a given from the discussions we've been hearing so far. So what are the two amounts here that are being discussed? So amount A is really the share of the residual profit that's allocated to market countries. It's going to be based on a formula approach, and it's really 25% of the residual profits above the 10% threshold. So once the company exceeds 10%, then we're talking about 25% of after that. It's going to be a revenue-based allocation key, and it'll apply regardless of whether the business has a physical presence in that market country. As I was saying earlier, the objective here is really to focus on the transaction between the company and the customer. There's also amount B, which is completely separate from what I understand from the 20 billion euro and 10% profitability rule. This is really just the standardized remuneration of related party distributors that perform baseline marketing and distribution activities. So it's not subject to the scope limitations of A, and the idea is to look at distribution, like a type of return that you would provide on that, and ultimately by setting safe harbor rules around that, that would help provide certainty, but also reduce tax disputes. Global 2 is what we often talk about being the global minimum tax. So the predominant feature here is that it introduces a minimum effective tax rate of 15% in a jurisdiction on the profits of large multinational enterprises. So it applies to multinational enterprises with annual revenues of 750 million euro or more, and it is based on the global anti-base erosion rules, or the GLOBE, and they are key to the implementation because it helps standardize the income calculation for all the jurisdictions. Now, we won't go too much into it now, but there's also the subject to tax rule, which is different from the global minimum tax. It allows a source jurisdiction to tax up to a 9% minimum on intergroup payments, such as royalties and interest, and the OECD guidance is currently under development. So that's something to watch. But ultimately, the key factor here is everyone is focused on the first aspect, which is the 15% global minimum tax. So how is this going to be calculated? Trust me, it's much more complex than this. If you look at the OECD materials, it breaks down various scenarios on how to calculate, and Laura can give you some real world examples as to how complex it's going to be in her organization. But ultimately, we're looking at 5 steps. Step 1 is determine which entities are in scope and their location, and which entities are not in scope. So you'll have full cross-section from the MNE when you look at the org chart, which ones will apply. Then you determine the globe income in each jurisdiction or constituent entity. The third step is really taking that income and determining how many taxes were paid based on that and the overall income of that entity. Step 4 is calculating the effective tax rate and, if applicable, a top-up tax. So this is where the 15% kicks in. If it's determined that your effective tax rate was only 12% that you paid, then there's going to be a top-up to get to the 15%. There are 2 mechanisms currently being considered for that top-up, and that's step 5. So the first one is the income inclusion rule, where the jurisdiction of the ultimate parent will then have the ability to tax up the MNE component that has not paid the 15%. The other one is the undertaxed profits rule. So if the income inclusion rule hasn't been brought into force in the country where the ultimate parent is located, the jurisdiction where the taxes have not reached 12% could increase it to 15% in their local jurisdiction. Again, the mechanics of all this is much more complex, but this is just an overview of how it's going to proceed. So what's the progress so far? So on Pillar 1, work on the multilateral convention is still ongoing and scheduled for mid-2003. They're targeting an implementation of 2024, but challenges still remain. EU countries, for example, they plan to implement Pillar 1 and remove all their digital sales taxes. So that's already well underway. However, in the United States, for example, it's going to be a bit more difficult because they have to get congressional approval to pass the measure. And it's not sure that Congress will support this kind of measure, seeing as some of the companies targeted by the thresholds of Pillar 1 are US-based. And then finally, other countries, such as Kenya and Nigeria, might be reluctant to eliminate their digital sales taxes, ultimately because they're receiving a lot of revenue from it, and they have criticized the thresholds as being too high. Ultimately, for example, why not 10 billion euro versus 20, or the profitability threshold bringing down to from 10 to 5%. Pillar 2 is way more advanced compared to Pillar 1. So on February 2nd, the OECD published the administrative guidance on the implementation of the global minimum tax. It provides details on the overall implementation, including how the United States Global Intangible Low Taxed Income Rule, or GILTI, will be implemented within the framework of GLOBE. And then the guidance will be integrated in the GLOBE commentary, and examples will be released later in the year. The OECD has indicated that the guidance represents the final piece of work on the GLOBE rules, and once finalized, it'll be up to individual countries to incorporate into domestic law. So now we'll turn it over to Nihat, who will discuss a bit of the parameters around, which companies are actually in scope using some of the databases that she has at her disposal.
Great, thank you so much, Andre, for your presentation. I'll share my screen here. Let me know once you can see it. So can you see my screen?
Yep.
Okay.
Yep.
So for those who are not aware, I head up tax and TP for Moody's, erstwhile known as BVD. We have data solutions that help within the tax and transfer pricing compliance. One of our flagship products is called Orbis, which is the company database of around 450 million companies and plus. Obviously, this database is being used by not every, but most of the tax authorities globally who have transfer pricing and tax as a regime in place. We work with a lot of big fours as well as small mid-tier firms and likewise. Pillar one, pillar two has been the talk of the hour in respect to how and what can we expect as a result of adoption of this, which is going to be very soon. One of the biggest questions that come into the play is how you can see for yourself as a company or as a professional service for your client on where you're present in this chart, on this map, in terms of where you see yourself. So as Andre explained, pillar one, I think there are certain criteria of where and how can we construe a particular company to fall within the selection or the population of companies that get affected by pillar one and respectively pillar two. So I just decided to run a particular example in our databases to show you a pictorial view of what these companies could look like and what would that mean from your standpoint. Again, whether you're a corporate and you can do a research of something similar sort on your own group to determine if you have subsidiaries, if you fall within the 20 billion turnover range and things like that, how can you kind of be mindful around this? So as you can see on my screen, I'm logged into Orbis. It has around 450 million companies. I started applying some search screens, as you can see. My first search step is around active companies only, that I was looking only for active companies that are actively working and have financials, last year's financials filed, that can be used in any kind of analysis. My second step is around the operating turnover range that's applicable on the pillar one amount A, wherein we want companies which have at least 20 billion operating turnover in USD. I'm only using the last year into the consideration, and that gives me around 1,289 companies globally. If I have to screen that further down for out of these 1,289 companies, which of them have subsidiaries in South and Central America, we have around 491 companies. So basically, there are 491 companies globally present out there that have some sort of presence in terms of subsidiaries and everything in South America. Now, that does not necessarily mean that the locations in South America would have that kind of revenue and would definitely fall into it. But the group overall would be something that can be questioned into or would require to comply with these regulations. Now, if I want to find companies with 20 billion and above 20 billion and above revenue in Central and South America.
147 mensajes, un ratito.
Oh, sorry, was that a question?
I guess you can continue, Neha.
Okay. So let's say I want to find companies with 20 billion above in the USD revenue in Central and South America. So not the subsidiaries of the global group that I was trying to find earlier, but the actual companies with having that kind of revenue. We have around 62 companies. So depending on what scope you want to look into, what's the kind of location. Now I can screen this further down into any specific country in South America, let's say Colombia, let's say Brazil, let's say Mexico, and I can try and find how many companies are there which fall within the pillar one application of the regulation. So if I have to see these 62 companies, you can see broadly there's a JDN company that's in Cayman Island, Alibaba Group that has a location in Cayman Island as well. There's some Chinese entities, again, having some location in Cayman Island, Petroleus and Mexicanos in Mexico, and likewise. So let's see if I have to open one of such reports. And I open Petroleus Mexicano. Now you can, as a user, look into the data in terms of where and how is the potential of earning for this company. So as I can see, there are some financial thresholds out here. One of the things I can look into is the corporate group ownership, wherein I can try and find out what the ownership might look like for this company on the LATAM level, like the Latin American level or global level. Another interesting way of looking at this would be looking at those 491 companies globally and out of which how many of them have subsidiaries in Latin America, and then picking up from there. One such example that we ran was, give me 1 second. Was this, we had a paper, Moody's Analytics had a paper issued, a white paper, wherein we kind of explained on how you could use Orbis data to model a pillar 1 and pillar 2 example. And this picture kind of talks on that actually. Can you see it? Is it legible enough?
Yeah, we can see it.
Okay, so here we ran an example of a multinational that has an operating revenue of over 20 billion, and we tried to find the ownership linkages of that company within different jurisdictions. And as you can see, there's different countries in Asia like Thailand, Singapore, Vietnam, Malaysia, and etc., which have 100% ownership and fall within this pillar 1 requirement in terms of the reporting. Out of which the amount B are the ones that you see on the bottom here, which have marketing and distribution activities. And the way we found that was simply by going under the search and screening this further down based on the activities and industry. So if I do want to find distribution and marketing companies for the amount B rationale, I could also do that right here. So does that make sense? Any questions before I move forward? So there's one more example out here on the pillar 2 modeling, which is also similar, wherein the M&E of greater than $750 million and how they have low tax entity falling under different jurisdictions with complete ownership, and how they function within the minimum tax of around 15%. I can drill this further down, but I don't want to overwhelm the audience in terms of how we can kind of create this. What I want you to take away with yourselves is the fact that you can run around various search parameters to bring this further down to a certain number of companies that would help you know where these companies are located, if they fall within the coverage of the companies or not, and then take it from there. If there are any more questions, I can take it, but I think if that is it, I would like to hand it over to Laura.
Great. Well, thank you so much, Neha. That was really interesting and really good to see the stats. So, I'll talk from the perspective of an in-house tax professional. So I work for McKesson, which is a pharmaceutical company. We've been planning for the additional compliance burden and the implications of these new tax regimes for some time, more so from a Pillar 2 perspective, because from what I've heard, Pillar 1 is pretty much going to be dead on arrival. It's like Andre mentioned earlier, it's very unlikely that the U.S. Congress is going to support Pillar 1. And so if that's the case, we think that, it might struggle to get other countries' support as well, because, there's that lack of critical mass. So we've really been focusing our attention on Pillar 2, and we've been spending some time on the modeling to see how we can get as many jurisdictions as possible to pass the safe harbor tests. And we're also just taking a closer look at the countries that are at the cusp of passing the safe harbor test and seeing if there's anything we can do at this point to make sure that these jurisdictions will pass the safe harbor test in a year or two. And also my understanding is that, the taxpayers have the option to pick and choose which accounting standard they want to rely on for purposes of Pillar 2. As a U.S. company, we've historically relied on the U.S. GAAP for our CBC reporting. But for Pillar 2, we might have an opportunity to look into what our results would be if we relied on, other accounting standards such as IFRS or local GAAP, right? So of course, the additional modeling is going to require some time and resources to do, and the data gathering and the validation is going to be key and a real challenge for us. So, right now, all of the modeling that we've done so far have been based on our FY22 data, which is already 1 year old, right? So once we have our FY23 CBCR data, I think, that updated analysis will really be critical because that's going to drive some of our tax planning decisions, depending on what our safe harbor tests look like. And also from a process perspective, right now there's so many new things that we're learning about on Pillar 2 in terms of the new data requirements. But at the end of the day, there really should be a very high level of consistency across all the different reporting, from CBCR, like the EU public CBCR to Pillar 2, even down to the local country tax returns if possible. So I think this year, a key focus will be just, spending some time to kind of design a comprehensive and holistic approach to the data gathering so that you do that part of the work once only. And that information is fed into the different various reporting requirements. And one more thing to add, I think Pillar 2 is really, really complicated. In the US, we had a tax reform back in 2018. That's when we first were introduced to the global intangible low tax income with the GILTI tax, right? I thought that was complicated, right? But Pillar 2 is like GILTI on steroids. It really took a lot of overthinking and over-engineering to get to the state we are now. So I'm really hopeful that some of the calculations will be simplified by the time that the guidance become legislation in the countries. Because currently there are a lot of nuanced differences between the way, for example, you calculate the ETR for purposes of the simplified ETR safe harbor test, as opposed to the calculation of the GloBE top-up tax. And also the treatment of deferred taxes, that's a whole nother thing, right? There could be different treatments depending on what component of the GloBE tax you're calculating. So I think, all these complex rules are really putting an undue burden on the taxpayers. And I'm really hoping that there will be significant effort spent on simplifying these rules. On the Pillar 1 front, even though we don't think the US is going to adopt it, I think, I've heard that some countries like Canada and France might still go ahead with it. So, and also you're going to have countries that will still have the digital service tax, right? So I think regardless, there will be an increased risk of double taxation, which we'll have to deal with. And also, we don't know how the additional taxes paid under Pillar 1 and Pillar 2 in these foreign jurisdictions will be treated from a foreign tax credit perspective in the US. I have heard that some of the additional taxes under Pillar 1 might be treated more akin to a sales tax or a VAT tax rather than income tax, right? In which case you wouldn't get a tax credit because it's not an income tax. So in the event of double taxation, right now, MAP is, the best avenue to address this kind of issues. But I could just see like a ridiculous number of taxpayers having to go through MAP to get their issues resolved. And do we really want to invest like 3 to 5 years on each MAP case? Like, that's a humongous investment. So all of these concerns are definitely keeping us busy, as a US-based multinational. So I want to pass the torch to Gaston and Evan. What are your perspectives on the implementation of Pillar 1 and Pillar 2 for Latin American countries?
Well, thank you for your introduction, Laura, and what you explained. What we have done regarding our research in Pillar 1 and Pillar 2 in Latin America, we split our work into it is open the well. And what we have researched is that what we have researched is that Pillar 1 and Pillar 2 is quite difficult to be applied in Latin American region, but we think that there is different barriers that the tax authority of the government applied here. For example, in the case of Pillar 1, and there is like digital tax, digital service tax in the case of, for example, in Chile, or a significant presence is the case in Colombia, or or there's important variance in withholding tax. That is the case of Brazil, or withholding tax at the moment of the payment via credit card also. So those are the ways that they are trying to apply like Pillar 1 or to put a barrier here in Latin America. On the other hand, even we talk about Pillar 2, and please, even your...
Thank you, Gaston. Well, the situation in Latin America, and especially in Central America and the Caribbean, is quite different from the global perspective on Pillar 1 and Pillar 2. You can imagine that our challenges for the tax authorities are quite basic. And Pillar 1 and Pillar 2 are an approach that feels like something that is not quite that relevant, facing the challenges we have in our region. In Central America and in the Caribbean, there are only two countries, Mexico and Costa Rica, including Mexico in the Latin north part of the subcontinent region. They are the only two countries that are part of the OECD. And even the statement on two-pillar solution has not been signed by many countries in the region. So you can expect that the implementation of such solutions as Pillar 1 and Pillar 2 are quite in a very, very early stages, and there's not a feeling that Pillar 1 would be something that is important for the local taxpayers and even for the tax authorities. In that case, Pillar 2 is the more interested pillar of the two pillars that the region is reviewing. But if you take into account that most of the structure, the fiscal structures in the Central America and the Caribbean region have a lot of incentives, tax incentive, then you can easily understand that we are in a situation that we are identified as low tax countries. In that case, there would have to be a lot of tax reform in order to try to comply with the Pillar 2, with the Pillar 2 assumptions and the Pillar 2 global minimum tax. For example, in Panama, we have a special regime for multinationals that they only pay 5%. And that was a recent tax reform that introduced tax for multinational entities. Before that, multinational entities that registered themselves had a special tax regime in which they did not have to pay any taxes for their income tax. You must also take into account that many countries in our region, they do not have income tax for foreign income. And that makes it even more complex to apply the Pillar 2 in our region. Another thing to take into account is that a digital sales tax is something that was in the first moment of discussion tried to introduce, but many of our countries just decided to incorporate the value-added tax to the transactions. The problem is that our countries are not prepared to engage with the banking system in order to be able to withdraw tax to the banking system. So, as you can see, there are many challenges in order to implement Pillar 1 or Pillar 2 in our regions. The first one is that our countries have another issues that consider more relevant in this moment. The second thing is the implementation, the complexity of implementation, and the need to embed information and process with the banking system is in a very, very early stage. And many of our countries have decided to wait and see how does the global fund really applies this pillar 1 or pillar 2 in order to advance in the local implementation. As Laura said, there is a preview that in the US it won't go. The pillar 1 wouldn't get to a safe harbor, so we don't see that the region in Latin America having approved or implemented the pillar 1 of the OECD. And as I said, in pillar 2, there are so many reforms that have to be made in order to really apply pillar 2 in our countries that we don't see it in the short term viable in order to see, hey, this region is complying with what the OECD expected. And that is a situation that we foresee for the next 5 years.
Yes. Well, what we have done is we will share our presentation is as you can see. For question of time, we are not going to explain each of the country, but we will show you this research that we have done with Ivan, and we highlight the principal things of in each country regarding pillar 1 and pillar 2. As I said, pillar 2 in some countries, as Ivan said, in some countries quite difficult to be implemented, but in most of Latin American countries, the effective tax rate is above the 15%. Regarding pillar 1, well, as said, the barrier is digital tax, digital service tax or withholding tax, and what the important countries in pillar 1 are, or in which are most large company, as you see in this presentation, are Mexico and Brazil. But well, Brazil have a particular tax regime, and not only because of transfer pricing, but also because they have a very high withholding tax. That will be like the barrier that they put in pillar 1. No? So we will share this presentation. It's split in Central America and Caribbean, Panama, Republic Dominican, Costa Rica, and Mexico, and South America, Colombia, Brazil, Argentina, Peru, Uruguay, and Chile. I think that with Evan, what we think is it will be useful for all to have a highlight of how pillar 1 and pillar 2 are applying in our region. Well, from our point of this presentation, if you have any question or if you have any things to share with us regarding Latin America or your point of view, please be yourself to say.